finally offer the other side of the coin. I've really only offered the bull thesis. Now I'm going to offer the bear thesis. So to begin, we all have to get on the same page regarding the economic environment that we are in. Right now, I would characterize this market, particularly with regard to monetary policy, as a major inflection point. Okay? Traditional monetary policy no longer works. Okay? First, you can see this in interest rate policy, right? Traditionally, the way the system is supposed to work is the Fed has a lever. They can raise interest rates or they can lower interest rates. If the economy gets too hot and they need to slow things down, inflation starts to pick up, you raise interest rates, make it more expensive for credit to get into the system, and then boom, things start to cool off. If you're in a recession, you need to stimulate the economy, you lower the lever and you lower interest rates, greater access to credit, expansionary policy, right? But that lever is broken. That lever no longer works. Why? Because in 2008, 2009, we lowered it all the way to zero, and then we kept it there for a long time. And so if another recession comes along like we're in right now, you can't lower the lever any further, unless you're the European Union and you experiment with negative interest rates. But that, of course, comes with its own slew of problems, and Jerome Powell has acknowledged that he's not going to do that in the United States. And so that lever is completely broken. Okay, so what do you do after that? You no longer have your interest rate lever. Then you move to quantitative easing. But quantitative easing is also broken, and it's broken for a couple of reasons. One, we're running out of bonds to buy. We're running out of stuff that the Federal Reserve can go and buy, right? Quantitative easing was never supposed to go beyond U.S. Treasuries. Again, I've said this repeatedly. It's illegal for the Federal Reserve to purchase anything other than government-issued debt, which is why they have to set up these special purpose vehicles to go buy other debt instruments. But what other things is the Fed going to buy? In 2008, 2009, they expanded it beyond just government debt, and they started to buy mortgage-backed securities and asset-backed securities. Now, of course, they're buying the entire investment-grade corporate bond market. They're buying pieces of the junk bond corporate market, and they're buying junk bond ETFs. And so what else are you going to buy as a part of a new quantitative easing program? You could buy stocks. You could buy stock ETFs, which would be the single most insane monetary policy action I've ever seen in the entire lifetime of the Federal Reserve. I highly, highly doubt that's going to happen. And if it did, it would be absolutely insane. So quantitative easing no longer works because there's nothing else for us to buy. And as it turns out, quantitative easing doesn't really do a whole lot to stimulate the real economy. As it turns out, if you get laid off from your job and are no longer working for a living, the Federal Reserve buying corporate bonds isn't going to help you that much, now is it? Right? It turns out that both lowering interest rates and engaging in quantitative easing doesn't do a whole lot to stimulate the real economy. Additionally, people like to talk about how we're in a period where stock prices are so disconnected from fundamentals, but this is really no different than what we've been doing over the past 11 years. It's only been exacerbated by the pandemic because the underlying economy is so bad. But only in a world where you have 0% interest rates and unlimited quantitative easing can you have the slowest economic recovery since World War II while also having an 11-year-long bull market where the S&P 500 goes up 400%. Okay? But nobody was really talking about the gap then, but we're talking about it now. And so what this has forced policymakers to do is experiment with new and innovative ways to try and stimulate the economy. And you're seeing this first with monetary policy coordinating with fiscal policy. It turns out that writing people a check for $1,200 and depositing it in their bank account does more for the real economy than the Fed buying corporate bonds. And so you're seeing some coordination between Jerome Powell and Steven Mnuchin, right? That's the first thing. And then the second thing you're starting to see is yield curve control. And we've talked about this a bit in the video I did leading up to the last Fed meeting, but I, for one, predict that yield curve control is probably going to come by September in the United States. Yield curve control has already been implemented in the Bank of Japan since 2016. Australia recently implemented this policy, which means that the Bank of England and the Federal Reserve is not far off. Now, for those of you that don't know, yield curve control is essentially a policy very, very similar to quantitative easing. Quantitative easing says we're going to buy a certain quantity of a certain kind of bond. So we're going to do 50 billion in mortgage-backed securities or 100 billion in corporate securities or whatever it may be. Yield curve control doesn't specify a certain quantity of bonds that you're going to buy, but rather targets a specific yield. and then buys however many bonds it needs to buy in order to achieve that yield. So they could say, we're going to target the 5-year part of the curve and we're going to target a 50 basis points yield. And if it's currently at 60 basis points, then they're going to buy as much as they need to buy in order to push that yield down to 50 basis points. Now, I predict, again, that the Federal Reserve is probably going to implement something similar by September. And a lot of economists think the same thing. And you can see this in the shape of the yield curve right now. You can see that that certain part of the curve between like the 1-year and the 10-year is being artificially pushed down right now because traders are pricing in that you're going to see yield curve control. And if it were to come, it would be in that part of the curve, right? This acts as a steepener, right? It pushes the short end of the curve down, which makes the entire curve look a little bit steeper. Now, what effect is this going to have on the bond market and on the equity market? It's going to raise it even further. It's going to inflate the bubble even further, right? Because people are going to continue to chase yield. If you push down yield at the short end of the curve, people are going to get pushed into the longer end of the curve, right? Which is more risky. And then people in the long end of the curve are going to go get into the corporate bond market. And then people in the corporate bond market are going to go get into the high yield market. And then from the high yield market, you move to the stock market. And then from the stock market, you move to the private equity market. So everything is going to get inflated. Now, obviously, it depends a lot on which part of the curve they target and what they set as the target yield. But nevertheless, short of something pretty spectacular, it's probably going to inflate asset prices even further. So, in conclusion, we are basically in an environment right now where the Federal Reserve, in coordination with the federal government, are doing every single thing they can to prop up asset prices, which is only going to make the gap between the real economy and asset prices grow even further. So how does this end? How does this bubble burst? Well, first, let's talk about the scenario where it doesn't burst at all, right? You have the real economy down here, and you have asset prices down here, and you have the Fed in the middle. If the underlying economy picks up, if productivity grows such that the real economy can close this gap, then once they close that gap, the Fed could step away and then boom, there's no more bubble, nothing bursted, the stock market doesn't go down, the credit market doesn't go down. That is the ideal scenario. That is the best possible case scenario. That is what everybody is hoping for. If that doesn't happen, there's going to be two things that pop this bubble. The first, and in my opinion, the more likely thing that's going to happen, is you're going to have really, really slow productivity growth. You're going to have slow growth in the real economy, right? If the real economy doesn't pick up and doesn't close that gap, eventually the Fed is going to have to walk away anyway, and asset prices are going to correct. This is exactly what happened, in my opinion, in late 2018, from September to December, when you saw the stock market sell off 20%. Because again, we were in an environment where the stock market was at that point on a 9-year-long bull run, yet we had the slowest economic recovery since World War II. And you can't keep interest rates at zero forever. You can't do quantitative easing forever. It doesn't make any sense. Again, that's what got us into this problem to begin with, because the lever no longer works. Quantitative easing no longer works. It has a diminishing effect if you use it too much. These tools were not meant to be perpetually used. You take it out once for a short period of time when you're in a real problem, and then you put it away and wait for the next thing to come along. But if you decide you're going to do it for as long as possible, but real growth doesn't pick up, eventually the Fed has to walk away. And that's exactly what they did in September of 2018 when they hiked interest rates, and it caused the stock market to sell off. So in my opinion, the number one thing to look out for is growth in the real economy. If it doesn't pick up at the rate that it should, if people aren't getting back on planes, they're not getting back in restaurants, they're not going out and doing things, they're not spending money, if that recovery is slow, then eventually the Fed is going to have to walk away. And I think they're targeting 2023 for raising interest rates. And so if by 2023, the real economy hasn't really recovered that much, you're going to see a drop in asset price. So that's the first thing. The second thing is inflation. If inflation rears its ugly head, it's going to spell a disaster, an absolute disaster for asset prices. Now, I know it's hard to believe in an environment where you have this massive demand shock and everybody's cooped up in their houses and nobody's spending any money, that inflation could rise, especially since we've had a historically long period of historically low inflation. It's been the Federal Reserve's job to target a roughly 2% inflation rate, and they haven't even really been able to meet that target recently. So it's really hard to believe that inflation is going to come. And it's not at the forefront of people's minds, but it should be. Because if inflation starts to pick up, it will be a disaster for the stock market. And you're already seeing certain pockets where inflation, which might cause inflation to go up, right? Oil prices in particular have rallied pretty spectacularly since the futures went negative back in May, right? The price war between Saudi Arabia and Russia has largely been squashed. And oil prices are obviously a big component of inflation. And so if oil prices go up, inflation goes up. You're also seeing supply chains get reconfigured as a result of this virus. Not only are you going to have supply chains move out of China or reduce exposure to China, but they're also going to have to be retrofitted and completely changed to make sure that they're not spreading the virus, right? You're seeing this in like the meat market, for example. The price of meat has completely skyrocketed because the amount of money that they've had to invest to make sure that they're not actually spreading the virus, right, is going to cause prices to rise. And then the third and most obvious thing is that we've just been throwing so much money into the system. The actual money supply has gone up almost, I don't know what the exact rate is. It's gone up significantly since March. And when you have a lot more money in the system, naturally inflation follows. All of the money that's been pumped into the system has basically buoyed asset prices through this crisis, right? When you go to the grocery store or you go to a supermarket or whatever to go and buy goods, you haven't seen prices fall. If anything, you've seen certain prices rise, like the meat market. Again, that's because when you throw a bunch of money in the system, there's some price stability there. And so I'm concerned that if the economy does start to pick back up, demand starts to pick back up, you have all of this money in the system, you have rising oil prices, you have supply chains being reconfigured such that the price of goods starts to rise, you might find yourself in a spiral where inflation starts to pick up. And that would be an absolute disaster for asset prices. Because how do you fight inflation? What's the one thing that you have to do if you want to quell inflation? You have to raise interest rates and you have to pull money from the system. Inflation would effectively force the Fed out of the equation, which would basically cause asset prices to drop right back in line with wherever the real economy is. And so it's a very, very big concern. It's not nearly as likely as having low productivity growth, but it is there, and it is something you need to watch out for. And so I'm watching the inflation prints very, very carefully. If you start to see inflation really, really pick up over the next couple of years as we get through this recovery, it could be a disaster for asset prices. So